And greetings to Thursday. I'm going to start with Carl Denninger, market ticker, because I still look at his stuff and admire his quantity of output. Same with Mish, absolutely dedicated to their job of producing content. This is one of his favourite charts, and it is debt in the United States 1980 to right up to date, and he updates it from the Z1 the moment the day it's released. It's wonderful service. So let's go along them because Carl's put them up for us. Household credit at the bottom in dark red and going up. So we can see that's gone down, household. Non-business credit, non-financial business credit has gone up slightly. That's because the businesses have taken their available credit lines from the banks. Coming down an awful lot of financial instruments. The rest of the world, state and local government are the same, and the one, so you can see besides the pink one at the, let's start again. 3, 2, 1. And welcome to another Thursday. And I'm going to go with Carl Denninger market ticker because I admire his quantity of output. And his debt in the United States, 1980 up to the present day. And it's right up to the present because Carl keeps it updated the day the figures come out. It's a wonderful service. So going along, let's go from the bottom up. Household credit in red we can see has gone down. Non-financial business credit has gone up. Financial instruments have come down a lot. Rest of the world, state and local government has gone up only very slightly. But so let's stop there at the powder blue, and we can see that overall at the powder blue level the debt in the United States has come down, but the thing that's made it about stable or slightly going up is the dark pink, which is the federal government. If the government hadn't been borrowing, the overall debt in the United States would be going down. Thank you, Carl. This is... I've forgotten the name of the blog. I've only just come onto it in the last few weeks or so, and he writes some good stuff. I've used a couple of them before. It's not Sudden Debt. Forget the name of it. I'll look it up right now because it'll be on here. Sober Look, it's called. And he writes some good stuff. Right. So talking mainly about what happened yesterday, which was a strange day for the markets. Now, normally I don't go in for what happens on one day, but Sober Look has a sober look at it. The dollar equities correlation reversal. The dollar's status as a safe haven currency came into question yesterday. Typically in risk-on equity rallies, we've seen the dollar sell off. I mean, this is all true. The reverse was also true as the dollar tended to rally in risk-off scenario. Safe haven currencies tend to be negatively correlated with risk assets such as equities, but yesterday, I suppose if you're going to listen to anything of this, it's yesterday we saw both equity markets and the dollar rally, which was true. So I've taken a chart out and moved two paragraphs together. The change in correlation from negative to positive may indicate the market's perception of US rates, interest rates, moving higher sooner than expected. You know, Bernanke said they're going to be low until forever, but maybe people don't now believe him. The Fed funds futures curve has shifted the expectations of the first Fed rate hike to June of next year. These changed expectations should bode well for the dollar going forward, and days of the correlation reversal may become more common occurrence. In other words, what happened yesterday with treasuries getting whacked and gold and silver getting whacked, but equities doing quite well and the dollar getting quite well, we might see more days of those in the future. Should I leave it there? Yeah, because it was a strange day. But I'll note that I have just noted in the last couple of videos somewhere along the line, I said there should be a ceiling on the rise of the dollar. Bernanke will not be wanting the dollar to rise too much, because if the dollar rises too much, it hurts exports, and the export sector for the United States, among other things, is doing quite well. That's relatively well. Let's move on to, that was one article of his yesterday, and he had another article yesterday, which I wouldn't have normally put in because the theme of oil was yesterday, but let's put it in anyway. Again, just to bust a few myths on this topic, the US oil production / exploration activities continue to increase sharply. This activity can be seen in the increase in the number of rigs, and that chart shows us the number of rigs drilling. It says US oil development activity, so these are oil rigs, presumably not oil and gas rigs, but you can see the enormous quantity movement from 2009, where there were a mere 200, and now there are 1,000 rigs pumping away. But that's a bit annoying. This is what I noted. It's obviously good stuff, but this was US oil production / exploration activities. Well, which is it? Is it production or is it exploration? Exploration doesn't always definitely mean production, and there will be a factoring in how much exploration you need for how much production. It was just a bitty way of putting it, meaning that showing to me that he doesn't really grok this particular subject. Anyway, he did drag out another EIA chart, which again was in the article, his article, to prove how well America is doing with its oil production. And it is. I hope I haven't given the impression that it isn't. Oil is going up, and obviously the gas is really pumping. But if you look in this chart from the EIA, non-OPEC crude oil and liquid fuels production growth, we can see these are for 2011, 12, and a projection in blue for 13, and they'll probably not be far off with their projections for next year. They can go that far, and we can see for the United States the biggest stack-ups are 11, 12, and 13, and they're all positive. So what more could we want? It shows that the US, with all those rigs pumping away, are finding and pumping more oil. Cool bananas. But look at the numbers. Millions of barrels per day in 2011, 12 and 13. These are increases. So those 3 yearly increases will not even amount to 1 million barrels a day. It's a percentage, it's 3/4 of 1 million barrels a day. It's not bad, it's great, it's fantastic. Much better than the others that are negative over on the other side, like the United Kingdom on the other side. It's got one up, which was 2012. 2011 was very negative, and the projection for 2013 is negative. They are going to lose production, but by half a million barrels a day, and America will be up by 3/4 of a million barrels a day. It's good, but it's not ripping. Coming down, Canada's up, Kazakhstan's up, Colombia's up, Chile and Brazil are up. They're up, but look the amounts they're up. 200,000 barrels a day. We're talking 80 million barrels a day for the global consumption. It's not a... It all helps, but there's a lot that aren't helping. Have a look at Russia. Is the biggest producer now, bigger than Saudi, has been for, 8-9 years. Just under the 2011-12 number is Russia. They had a bad year. This year is projected, 2012, which are going to outweigh the positive 2011 and 13. So Russia's the biggest producer, but that's flat. But they're pumping out at about 10 million barrels a day. These are the absolutely micro amounts that are all adding up and taking away and making for lots of money at the pump. Anyway, that wasn't the theory, that wasn't the theme today, oil. So let's go to calculated risk chart number 4, loaded inbound and outbound containers, rolling 12-month average. In other words, it's smoothed. As you can see, the blue one is loaded in. This is stuff coming into LA. Really shows how the US, you could say the buyers in the shops, in the stores in America are buying in to sell, or you could just say how much the American people are buying. And obviously the great peak was 2007, before they realized the thing was foot. And then it went all the way down to 2010, quite late it was going down, and got itself back up again in 2011, but you can see it's falling over again slightly. And loaded out really hasn't, it's not going up and up. It's flattened out at a good high level. Exports are okay, but they're not blasting away, but they're good and solid. And this is the non-smoothed one, so you can see each spike up. There's more spiking in the blue because that's the loaded coming in, so each spike up's almost definitely for Christmas. That'll be the Christmas stock coming in. But you can see now, you can see the overall shape of it, and for the last 2 years the the highs have been lower, so you've got lower highs and lower lows. There's less stuff coming in. There is less retail activity in the United States from imported stuff. And there's even a nasty little tickle down on the loaded out for exporting. But the exports, the trend is upwards, not bad, worth supporting. Right, this looks like it's the Wall Street Journal. Yeah, because it's Boskin. Long, a harbinger of national trends in the United States. California? Yes, California. Long, a harbinger of national trends and incubator of innovation. Cash-strapped California eagerly awaits a temporary revenue surge from Facebook IPO stock options and capital gains. Yeah, the absolute billions is going to go in when Facebook floats. It's incredible, isn't it? Meanwhile, Stockton may soon become the state's largest city to go bust. Call it the agony and the ecstasy of contemporary California. Nice writing. Boskin does do some nice writing. California's rising standards of living and outstanding public schools and universities once attracted millions seeking upward economic mobility. But then, Mr. Comma there, but then something went radically wrong as California legislators and governors built a welfare state on high tax rates, liberal entitlement benefits and excessive regulation. The result, though predictable, are nonetheless striking. From the mid-80s to 2005, California's population grew by 10 million. While Medicaid recipients soared by 7 million. Tax filers paying income taxes rose by just 150,000, and the prison population swelled by 115,000. And I've juxtapositioned that next to Spain in the Eurozone. It's not quite Greece, California, but it's kind of Spain. And this is Wall Street Journal again, which is showing that wonderful picture, which is a Eurocrat strangling a Spanish finance minister because Spain had been told that their budget was too much over the new signed contract that they were not allowed to go over. But the day that they signed it, they said, well, we're going to go over anyway. And the Eurozone people have now said, well, all right, but don't do it too much. It's pathetic. But that's a nice picture. In the Telegraph, we read Athens has probably cut spending enough to bring its primary deficit down to 1.5% this year, as agreed, but current projections reveal large fiscal gaps in 2013-14. They've just backloaded it. According to a leaked draft of something or other, In the report, the Troika said Athens will have to impose further fiscal cuts of much as 5.5% of GDP. That's a lot. To meet next year's targets. The report says substantial additional expenditure cuts will have to be announced and adopted by Greece in the coming months, in particular when Greece updates its medium-term budget. In other words, they've screwed everything in to get the last agreement through. And I was just reading in the Financial Times that everyone's talking about this 130 billion euro bailout, and it's not anything of the sort. If you really read into it, it's 160. If you can read it in another way, it's nearer 180 billion. So, but it's the way things will go in the future. These bailouts, which are really extra lendings and screwing downs, something has to happen, and that's the way they'll go probably. Ireland battles for relief on debt repayments. Let's not go into it. You can imagine the poor Irish are saying, we're paying up, but they're not. And they want something. They must be thrown some sort of a fish. If only because they've got a referendum coming up on the bit of paper everybody signed. But what's the point of fussing about the piece of paper everybody signed that they were going to be austere in their budgets when the day that they signed it, Spain said they were going to take no notice of it. And then a few days later, the Euro people said, well, yeah, that's probably all right. So Ireland should be thrown a fish, but they really don't have to throw them a fish at all. Right, finish with China, because my macro idea is that Europe will go down, America will threaten to go up, but really stay at blah, and the East will run into a wall sometime certainly in the next 6 to 18 months. Tough Medicine and Hard Landing for China by Michael Pettis, and if Michael Pettis says it, as far as I'm concerned, it is the true thing. And that's the end. We'll just repeat it. The East are going to run into trouble. Whether it's because of what happens in the West, I don't think it is. I think it's just this credit crunch tsunami is going to land on their shores, and they are going to run into terrible trouble. And with the Eurozone in trouble and America only pretending to be out of trouble, we're still all in a load of trouble. And what happened yesterday, and people thinking, risk on, let's go party, they are short-term players. They can go and party for a while and pull on out. Don't be going and partying with them. Stay on the safe side. Bye.